Welcome to my video on who uses the futures market. Now, be an active learner as always. As I write information down on the board, you do the same. It'll help you retain the content and answer questions later. But in this video, it really kind of continues our talk on the futures market, which I described as one of the major markets. It's called the CME group. And then we're talking about corn as our example product in our videos here. And we're talking about who uses the market, but I should begin with risk. So what is the risk in the market? Well, remember, we've got two players. We've got a buyer and we've got a seller. And those are the two folks that are in the market. And what is the buyer of this corn? Let's start with the seller. I've got this corn growing in the field. What is the seller worried about? Well, they're worried about the price going down. Kind of that is their big concern, right? If the price goes down, they would lose money. They've spent the money to plant it. They looked at what the price was. They couldn't really get a contract put together. So they looked at that price, and as they grew that corn throughout the year, they're worried about the price going down. Well, the buyers, they have risk as well because they look at this corn crop and they're like, wow, I really want to buy that corn. I'm not ready for it. I'll be ready for it in 3 months. Let's say it's December. Well, that'd be a bad time to plant corn, but we're looking at a time when that corn's in the ground, and then we're going all the way till, let's say, 3 or 4 months out, and that's when I actually need it. So what are they worried about? They're worried about the price going up. That is their concern. So these concerns translate to who uses the futures market, which is kind of our focus. Who uses this thing called the CME group or the futures market? So that's what we want to talk about. Well, let's break this conversation up into also two groups because there are two main players that use the market. And let me pull this over and talk about the first one. The first one, the number one I'm looking at, is called a speculator. Now, the use of the futures market for these folks is very similar to the way the word describes it. The speculator is concerned about making money, which is what either one of these people could be. In fact, the speculator is a player in the futures market that really can make money in two ways. Everything seems to come in twos, right? Two participants, two different participants in the market, or two who uses answers. But the speculator is one, and they make money. Again, write this down with me. They make money by finding an opportunity to buy when the price is low. And then they're going to wait over some time period, right? And then later on, they'll get a chance. They'll sell when the price goes back up. And this for them would create, you can write kind of a little bracket here, this creates profit. If I can buy a contract in the futures market on this corn, remember the futures market's trading these contracts all the time. Lots of buyers and sellers come in there to put positions on contracts that will be able to be traded for a period of time. Remember, they're always out in the future. So they're looking at, let's say today is December, and they're looking at all through time here. If they think the price is low, they take a buy position on a contract. Later on, that same contract's now trading higher. They sell it. That makes them have a profit. That's what a speculator does. Speculator also takes on another role. When they find that prices are high, then they can sell because the price is high. And then they wait for a period of time again. And then later on, they would then take a buy position back on that contract because the prices have now fallen. And that is going to give them the same result. They can make a profit. In fact, the futures market has been called by some folks, and it makes sense, the perfect business. Because when prices are, and this has been called this way, when prices are too low, a speculator grabs those and the market moves back to something normal and they're able to make money. Or prices have been inflated for some reason in the market. They can take a sell position later on when they fall back down, buy that same kind of contract and make money. So the idea of making money either way. So back over here to our corn producer and saying that there's two participants in the market, buyers and sellers. A speculator is playing both roles. Just depends on which role they think is the best opportunity to make money. That's what a speculator does. They are trading in the futures market, and they are making the market move up and move down based on what they see as far as indicators of the future price. So a speculator plays an important role in the market, and they are a participant in the futures market. They are one of the who's in the market. Well, what's another who? Let me change colors here so I can differentiate these a bit. But another player in the futures market, so another person that we need to focus on. In fact, for agriculture, this is our main focus. Number 2 is what we call a hedger. Now, a hedger is a person, for example, raising this corn. They're typically in one of these 2 roles, at least for a window of time that we're talking about. But a hedger comes to the market, the futures market, and says, I'd like to make money, but my main goal in the futures market is to protect their cash position. So write that down, that's very important. To protect their cash position. Because a hedger has, and I'll go ahead and write another one down here, they're involved in 2 markets. In fact, these 2 markets I need to lay out so we can talk about them. The first market that they're involved in is the cash market. So the cash market is going to be their local price, their normal place to harvest my corn and sell. That's the cash market. And their concern is that they could, over time, lose money. So I'm going to put a negative there. Their concern is this loss, just like we talked about before. That's their risk. Sellers are worried about the price going down. Buyers are worried about the price going up. So really a hedger could be either one of these. But they're in one market called the cash market, and their worry is that market will cause them to lose money. So how do they offset this risk? That's really what their goal is with futures, is they come in and get involved also in the futures market. And when they get involved in this futures market, their goal is to take the opposite position. So write down opposite position. That's the definition of a hedger. They're in the opposite position as they are in the cash. So what would happen is if they got hurt in the cash market, now don't worry about buyer, seller, price up, down, none of that really matters at this point. If the cash market over time hurts this trader or this grower, this buyer, this seller, either one, if the cash market hurts them, how could they position themselves in the futures market to get a gain? And that is how they offset their losses. So there's 2 to review. There are reasons why we participate in the futures market at all. Keeps going back to this idea of price risk. And I said risk here. Really what I mean is price risk. You might go note that in your notes. But this price risk is why we're involved. Now, who is involved in this futures market was our focus. And to review, that's a speculator. They are speculating on the price moves, and they can make money, buy low, sell high, or they can make money by starting off selling contracts and then buy them back later. Either way, they trade themselves out of the futures market, and their goal is to make a profit just on the price moves. A hedger is involved in 2 markets. They are involved in the futures, but they also have this local cash price they're involved in. That's where they really market their real commodity. They transport it where they need to. It's not hard for them. They know how to get rid of it. The problem is, or they know how to buy it. The problem is they are worried they'll lose money. So if they're in a position where they'd like to kind of try to protect that, they can take a loss in the cash because the futures market and the cash market kind of follow each other. They have to. That's really how they kind of correlate together. But if they lose money in the cash, they take the opposite position in the futures and can gain that money back. That helps them offset and protect risk. And that's really why the hedger's involved in the futures market, to manage price risk. All right, hopefully this video helps you understand who uses the market. There's a video that introduces this idea of the futures market. Check that out if you haven't already. And there are some videos that go over exact examples of this hedge, because that's really our main reason to try to understand the futures market. But hopefully this video helps you along the way. Make sure you take a look at the questions that go along with this video. They review these concepts to make sure that you've captured the important information. Thanks.